let's just kick it off. Like, if you guys want to just brief intro to the room, who you are, what you're up to, and we'll take it from there.
Yeah, sure. So hi, I'm Maredith Hannon. I lead business development for digital assets at WisdomTree Asset Management. We're a $110 billion asset manager. You may know us traditionally for ETFs, but we're doing a huge entree into tokenization, blockchain, and really see it as the evolution into the next realm of finance.
I'm Sid Powell. I'm the co-founder and CEO of Maple Finance. So for those who don't know us, we are an institutional lending platform. So we focus mostly on lending to crypto-native institutions. So think funds, trading desks, market makers. We've also done a lot in the real-world asset space. So we launched on Ethereum about 3 years ago. So we've done about $3.5 billion in loan volume since then. And since then, we've also expanded to Solana and Base. So very happy to be here.
Hey guys, I'm Reid. I run credit at Securitize. Securitize was founded in 2017, kind of one of the OGs in the tokenization world. We're probably most familiar today, at least, for working with BlackRock on their BUIDL fund, which I think is about 400 million right now, and about a month's time. So my focus on the credit side is more so on kind of being the bridge between TradFi and securities as tokenized assets, and then crypto and DeFi and permissionless activities. So excited to be with these guys, and looking forward to it. Yeah,
I told y'all we had a stacked panel. So excited for you guys to be here. I think I want to dive into like how each of your companies has a unique spot in this space. But what I first want to do is maybe just, Sid, since you have the mic, can you give us a mental framework of the market? Like I mentioned buy side and sell side, but who are the players on each side? Like give us a mental framework, then we'll talk about how you guys can solve, for each of those players.
Sounds good. We're starting with a small question. So if you look at real world assets, you have buy side, and this would include investors, people who want to allocate capital. So think at the very small end, you might have retail. And then as you progress to the larger end of town, you have high net worth investors, family offices, and then funds and asset managers. And this might include anything from hedge funds to an asset manager who might be managing money on behalf of, say, an L1 or an L2 foundations. I think like Cardano, Alva Labs. So that's the buy side. And then on the sell side, you have issuers. So this could include anyone from fintech originators who take in capital and then they make smaller loans to businesses, consumers, what have you. And they are big issuers of fixed income. And then you have larger companies like WisdomTree, BlackRock, and these are the very big end of town. And they have more, think of these as more kind of productized fixed income opportunities. So, short-dated government debt fund or corporate credit fund. And then in between, you have intermediary platforms. So this could include service providers like Securitize, who provide both a way of tokenizing the asset as well as a venue where you can access it, or a broker-like product where you can onboard and then purchase the assets. So buy-side investors, sell-side issuers, and then intermediary service providers who are like the exchanges or the tokenization platforms. Hope I did a good job.
Yeah. Anything you guys want to add in, or do you want to? He nailed it.
I thought it was really good.
Yeah. Nailed it. All right. Well, then let's do a little round robin here. If you guys just want to talk about where each of your companies like plays in the space and sort of the unique value prop you bring.
Yeah, sure. Do you want? Okay, yeah, sure. So I think you did a really good job of really explaining the ecosystem, but specifically for WisdomTree. So what's unique about tokenization is that we're actually straddling both sides of what was just described. So think of it, we can be the distributor through real world asset tokenization. So we have a suite of funds that are effective with the SEC here in the US that are a full range fixed income as well as equity products that are available to retail customers. But what's really cool and different about these is that they're tokenized, but then they're available, and I think we're going to get to this a little bit on what the hurdles are, is that they're distributed through an app that looks and feels like any other app that you would have on your phone. So while it's really cool that they're tokenized, what really is important is the utility of these. And I think as we take a step back and really focus on what our ethos is, it's all about thinking about the next evolution of finance. So the big question that we have as an ETF issuer is, what can do to ETFs that ETFs did to mutual funds? What's that next big thing? And we see that as tokenization and blockchain-enabled finance. So as we start to look at the market, we're providing products, but then we're also solving the problem of, okay, so how are end retail customers going to digest those products? How are they going to invest in them? What's a way that's easy and simple that you don't have to manage your own private keys, or that's something that my mom or my brothers who aren't in this space would actually be able to interact with? And I think it's that's really the linchpin that we're really focused on solving. So very solution-oriented focus in terms of what we're thinking about in the tokenization realm.
So Maple began as kind of a platform for lending. And so this was much more like trying to be the Uber of fixed income or credit on chain. Where we've evolved to now is, I would say, we're almost, we're still probably in that intermediary phase. And so if you look at our business model, we would find what we call lenders or investors. And so that can include high net worths, family offices, and funds. And then we borrow from them, and then we turn around and make loans to crypto funds, trading desks, generally in an over-collateralized format, or sometimes fintech lending companies. So from that instance, you could probably look at us as like an intermediary in that we provide a venue for this to occur. But the big problem, which I think we'll get to over the course of this panel, is distribution is really hard. So it's a very fragmented market, and there's a real premium in having a client base and being able to aggregate capital so that you can provide it to that fintech lender or that trading desk or that venture fund that wants to borrow against one of their positions. So at the moment, that's generally where we see the most demand, is for our service as kind of an aggregator of capital. And we do that by having this platform, which is maple.finance, and the smart contracts that we built.
So, I mean, I think Securitized is probably, somewhere in between these guys, right? So while WisdomTree is the asset manager, Securitized is really kind of the in-between layer. So we're asset manager agnostic, we're platform agnostic. We really have all of and I'll talk a lot about regulation, which is quite ironic for like my own, path to where I am today. But So Securitized is a broker-dealer license. We have an ATS. We have a RIA. We are very regulated entities. And so when we talk about real-world assets, there's also something to realize, which is there's big S securities that are real-world assets and tokenized, and then there's non-securities. And so we have the technology and the licensing to work with WisdomTree, other large asset managers, to be able to tokenize that in a legal compliant way, sell that, and then have the underlying technology to facilitate kind of the interoperability of those securities or non-securities with DeFi.
What is that called? The regulatory licensing that Securitized has?
So it's a broker-dealer license, which allows us to broker and deal in securities. So if you want to buy a security in the US, you largely have to do it through a broker-dealer. So only certain people, or entities rather, are allowed to sell those securities. We have an ATS, which is a trading venue license for those securities to then be able to be traded. An RIA allows you to advise investors on their investments. And then the underlying tech stack to basically allow those things to plug in with all of the protocols that everyone in this room would be familiar with.
Love it. Yeah, I think that's a really good segue. What I want to get into is like a sort of two-part question of like, who is demanding these things? Like, where is the demand coming from? Like, what are the personas that you're seeing of people who are interested in this? And then I always get asked this question, like, what asset class is going to be tokenized first? So maybe sort of a two-part question. I assume they're probably very interrelated.
So I'll start with who's buying these first. And I think the persona has kind of shifted since, let's say, start of last year. So in the post-FTX world, we're in more of a bear market in the space. And so people were very risk off. They didn't want any counterparty risk, and conservatism was the name of the day. So the persona last year was very much treasuries. So you might have a startup treasury, a DAO treasury, even high net worths. And they were looking for T-bill-like risk. And this was also exacerbated by Operation Choke Point 2.0, which for anyone who hasn't read was basically sort of the executive branch of the administration trying to clamp down on access to crypto, access to banking services by crypto companies. So what this meant was you might have a startup that raised 10 million bucks but can't open a bank account. And so they were saying, well, how do I get T-bill rates or money market rates on my assets? And so they were the main persona, was conservative, really liquid. And so that was why you saw this rise of tokenized T-bills, which was one of the fastest growing asset classes on chain last year. I'd say this year, now that we've gone into more of a bullish market environment, you're seeing more of a risk on attitude. So you're seeing maximal return, maximal yield. And this is kind of being led by high net worth investors and also hedge funds. So they're looking for higher returns. They're looking for things like private credit versus T-bills because it pays you a higher yield, or things like over-collateralized lending. So that's how the persona shifted over the last 12 months. And then the second part of the question was?
What asset class? But I think you've sort of answered it with T-bills and then now.
Yeah, and now the shift to like higher returning asset classes.
Yeah, sure. I would agree with that. I think there's another element to this too as well, though, that I do think is the retail market too. I mean, I know that's a little bit different from the private credit one, but I do think that the retail customer is still looking for yield. But I think what's a little bit different is around the utility of what that can look like. And I think this is more of an overarching, whether it's a bear market or a bull market, is we're all in search of something that's a little bit better than what we have today. And I think that's what tokenization and also real world assets can actually really offer, is thinking about all of the friction that you have in your everyday financial life. So whether that's paying your bills or your mortgage or moving, I know personally, I move money between this account and that account and a brokerage account and a checking account, and then I'm spending off of credit cards. And how do you think about how you can actually utilize your money more effectively? So whether that's yield, whether it's through different products, or whether it's just in how you're operating your own money, I think that's what's actually really could be transformative here. If you think about cross-border payments, remittances, even just how you're spending, so much of us keep so much cash in a checking account for your credit card. What if you could keep that all in the market, getting a yield, getting it, whether it's in T-bills or whether it's in a private credit fund, and then you're able to spend off of that where you're continuously earning 5+% versus sitting in cash earning nothing. And especially where inflation and rates are, that could mean serious money over time. So I think that's also another element too, that taking a step back and not looking so cyclical, there's also issues to solve in the existing banking infrastructure that you can actually solve with these products too. And it might seem little, and it's little changes in behavioral types of actions, but they could lead to overall return. So we're very focused on the retail market, as well as on the institutional side for some of the treasury plays that you're talking about. But again, we're much more of a public markets type of shop versus the alt side. So interested to hear what you say on the securitized front too.
Yeah, so I think securitized sits in like an interesting kind of straddle position. One is, we're very regulated, right? And so we don't deal with like retail, because regulation, and we'll get into this, I think, in the next topic, in regard to what are some of the friction points for adoption, is securities are regulated, and certain securities, whether you agree or not, are only available to rich people. And ever higher levels of rich people. And that doesn't change whether it's in a ledger form at a bank or an asset manager, or if it's on chain. So we have to play by a lot of those rules. But I think what's interesting is, there's an industry of $3 trillion roughly that's been created over, call it the last 14 years, 15 years essentially. And there's a lot of big players, at least on kind of the sell side, that have recognized like, oh, there's still a lot of inefficiency in even how crypto institutions are operating. So you can take a look at any of the tokenized money market funds and just the very real challenges that those institutions have, even just opening a bank account despite having however many billions of dollars of fresh capital raised on chain. And there's real challenges around how do you KYC those people to be able to actually get access to these products. And so there's still a ton of inefficiency from that side. So from our view, we're seeing kind of more of the TradFi community coming and saying like, oh, look, we can play in this space. There's a ton of inefficiencies that can be solved in the short term. And then let's make the products that we issue be kind of base level assets that crypto can then build on top of to make the industry more efficient, but also to be able to enlarge in distribution and find ways to make some of those securities that are otherwise restricted and who can hold them, kind of transmorph them into assets that can be held on chain by a broader diversity of investors.
Yeah, I think that's a good jumping off point to like transition to like what are the friction points, right? Like what are we seeing? We've mentioned a couple, but like what are the barriers in your view between where we are now and this amazing future that we've been, talking about?
Well, I think one of the big ones was touched on in the answers there, which is access to retail. So if you look at last cycle, you had a lot of access points for retail to crypto exposure. Not all of them ended well, but you had BlockFi, Celsius, and what a lot of these businesses did was they brought retail capital in, aggregated it, and then passed it into the ecosystem. Now, whether it was lending or use in other ways, whether it was deploying into DeFi or something else, that capital this cycle round is still kind of sitting on the sidelines. And there's not good access points for retail unless they go full permissionless DeFi to get the type of exposure that they were last cycle. And this also means that there's just less capital for, less lending can occur, less RWA originations can occur when that capital's sitting on the side, other things being equal. So I think that's one of the big friction points, I would say. Now, what you've seen this cycle is innovations like stablecoins that are yield bearing. So if you, last cycle, that would have been called a hedge fund. This cycle, that's now called a yield-bearing stablecoin. But that is a product that retail is accessing to the tune of billions of dollars this time round. And they find it useful. They can trade it with each other. They can earn a yield. I think Bybit just incorporated USDE, so now you can get a yield whilst you're using it as collateral. But that's one of the ways in which the space has responded to that friction and tried to kind of solve it on its own, as it did last year when it started tokenizing T-bills and giving access to crypto companies that couldn't open bank accounts.
I can't think of a better commercial for the app that we're launching, so thank you. I feel like I'm going to take you on the road with me. But that's why we're launching WisdomTree Prime, which is the app that we have, is because of that. Because there were a lot of apps out there that provided access, but it wasn't necessarily regulated in a way that was enforceable and also just safe and secure. So we think that there's definitely a market for that. But I think a lot of what Reid was saying in terms of just KYC and a lot of the regulation, I do think that's a really good point, because we are all coming and attacking this from a TradFi perspective of still working within the rules and regulations of what it is here in the US, where you need to be onboarded, where there is a process. And I do think that's important to the integrity of the ecosystem. So I think that's something that's still a friction point that we aren't necessarily going to solve today, but to start to create venues that we can build out these products and then bring on different types of users than we had in previous cycles, I think is really exciting. But I agree completely with Sid on the retail point. That's a big focus of ours as we just start to think and look forward, and also just making it easy, where you heard so many stories about, millions of dollars in a wallet that holds Bitcoin and they can't remember their pass keys, right? Like this is all of the nightmares that you have. That think about different ways and entry points in order to make it easier. And I also think identity is a big point too to that, that we're gonna really get into in this next cycle, that excites me about on-chain identity and what that looks like from a safety perspective, but also just from an access perspective. Yeah,
I'm not sure of the number of USDC that's been sent to
the actual USDC address. It's probably in the hundreds of millions of dollars.
So once again, regulation. So friction, again, we've talked about that. But I think the real issue is there really isn't utility to, well, I'd say two things. One, except for Maple's products, like there really are, like real world assets on chain are largely like shit. They're not quality. Like it's largely some people that decided that they were crypto before and now they're going to become asset managers. And they're just not quality. There's not transparency into them. And whether you like it or not, like securities do have in the US have a pretty good track record on transparency and a legal framework. The challenge though is there's nothing to do with these securities on chain today, right? Because of the regulation and issues like, can a smart contract be KYC'd? Can a security sit in a smart contract? Is that smart contract then a trading venue and you need to be a broker-dealer license? So like there's quality assets that are totally divorced from the realities of what's happening on chain, which is another element, which is, you know, before it was like you had Bitcoin, right? And if you wanted to get out, you sold it and you had some balance at an exchange and you hoped that maybe you'd be able to get your dollars out, you know, in a couple months or something. And then you had stable coins that were introduced. And then you look at, okay, well, the basis trade before, which was kind of like the risk-free rate on chain, was entirely driven by supply-demand dynamics of dollars. So if you think about being able to bring fixed income yields that have nothing to deal with kind of on-chain dynamics into the space in a security that you have confidence is ultimately going to be there because there's a regulated footprint around it. And how do we kind of bridge those you know, kind of three big friction points? It's ultimately finding a way to be able to have securities interact with on-chain dynamics, which we wouldn't still have this crypto economy if people didn't ultimately like interacting with it. And so that's kind of, I think, the core friction point, which isn't going to get solved anytime soon from the regulatory front, or maybe it will. But at least you do have kind of the optimistic side that like people use this because they like it and it's helpful to their life and it saves their businesses money. And that's, you know, I think that's kind of the light of the end of the tunnel from the regulatory point.
So before we totally move on, can you sort of talk about the evolution of credit on chain? I know you've got some pretty good riffs on this, and I'm just thinking, like, how do we conceptualize like credit in this on-chain world and like where we're going and like what that unlocks?
So, you know, I'll try to not use, I was a banker in a former life, so don't hold it against me. I will try to tone down my jargon. But you know, in traditional markets in the world, if you're a CFO or a CEO, you have a couple options for what your capital stack looks like. You can issue equity, which essentially gives away some of your upside, and you can also issue debt, right? And debt doesn't give away any equity; you pay interest. And if you run your business into the ground, then those guys are shit out of luck. I think what's interesting is, in the traditional world, that debt is normally priced at the risk of that business operation, right? But on chain, you have this interesting dynamic, which is like, oh, I can issue utility tokens, and I don't need to give away any of the upside. And then what's the role of debt? So you have a lot of crypto companies who raise, I don't know how many billions of dollars. And so then you ask, like, well, what's like really driving interest rates on chain? It's not risk. It's really a function of supply and demand. How many dollars are there for how much leverage people want to take? So I think one of the interesting kind of challenges that we face on chain is like all of these yields on most platforms are interconnected, and it's largely like an arbitrage function of who's providing incentives on this platform, and there's really no dynamic that really underpins like risk. So one of the things that's exciting, if you think about some of the other, look at private credit and the growth there, is being able to hold assets on chain, earn a yield, and it not be a function of what exchange is going bankrupt or what platform is throwing out, crazy incentives, and be able to keep your assets on chain, have self-custody of them, but also be able to earn a yield that's divorced from broader dynamics.
So the yield you can get on chain is very correlated to broader asset prices on chain. It still is, unfortunately. I think longer term it'll be divorced and it'll be more fundamental bottoms up, as in, what is the underlying risk here, and therefore price more efficiently. But in the short term, it's still a very inefficient market, and therefore it's mostly driven by, as Reid said, supply and demand. If you look at where interest rates are, and so you can look at a few different proxies for this. So the Aave lending rate is one that you can look at. And you'll see a pretty tight correlation between this and the basis funding rate from perps exchanges. And so when Bitcoin rips, interest rates go up, people pay groups like us more to borrow. And so if you looked, late last year, the rate to borrow against Bitcoin would have been like 8-9%. This year, that rate over the last couple of months has been something more like 15%. So unfortunately, the price of the large cap assets and the demand for leverage and speculation still largely drives the interest rates here. But the interesting dynamic that emerges is as you have more real world assets on chain, you can start to have non-correlated yields, which is what we saw tremendous demand for last year, where people wanted yield that was coming from both T-bills as well as things like private credit. We actually had a pool that was doing about 14% last year, and that was really in demand because it was perceived as not correlated with crypto asset prices. And I think as the space grows and matures, you'll start to see more of that kind of non-correlated yield, and eventually that'll probably flip the demand for yield from things like basis and futures funding rates.
Love it. Here, can I grab this real quick?
Yeah, sure.
All right, so before we transition to more of the forward-facing future stuff, like what you're excited about and what we should be looking about, want to do one more nuts and bolts question around how like an infrastructure provider like Chainlink fits into this vision that you guys are doing. When I was talking, we have things like CCIP and data feeds and all this sort of stuff that we feel provides the necessary utility, which Reid, you mentioned, is often missing in the first iteration of tokenized assets. So just curious, like how you see Chainlink and like infrastructure players playing a role in what your vision is.
Sure, I'm happy to start. This is definitely, as a traditional finance, publicly traded asset manager, it's an important question because no, especially heritage institution can do it alone. So we do leverage partners to build out our platforms, and it's an integral part of this. And I think especially as you start to think about interoperability, which I feel like is a big topic that a lot of people talk about, and even just thinking about what chains you want to build on, it's really important not only in the selection, but also in really the understanding of how the ecosystem is going to grow. So what that means is who you're partnering with, who their end customer is, and what value you're adding. And I think the big question that if you want to think about something leading this, I always like leaving these conversations with something to think about is what problem are we solving to make it better than what you can do today? And I think that's a really big opportunity for all of us, is to really think about from an ecosystem perspective. We can do a lot in the existing banking system. We all have talked about a lot of things that it was like a 101 traditional finance class too, a little bit up here, of all the different fundamentals that are really important to just how an economy functions. But then there's also really thinking about how do we make that better? And I think that's where things like CCIP or even just other infrastructure providers from a wallet perspective, from a smart contract perspective too, today you can't just flip a switch and buy a stock and do that through sending money, right? There's DTCC, there's clearinghouses, there's actual speed bumps that are there on purpose for good reasons. But I think that's something that could potentially be not eliminated, but made more efficient over time. And I think that's what's really exciting. If you think about what a smart contract really is that it's a better if-then statement. So if you think of, if I send money, then I receive something in return. And if you're both qualified to be able to do that and to submit that transaction, why shouldn't you receive that instantly? So I think it's a long-winded way of talking about infrastructure providers, but I think it's a really important, as you start to build out each piece to this puzzle, to make sure that you're thoughtful about what each provider does and make sure that those that are there are completing that picture. And I think those like Chainlink and others, and even I'll tout you guys, Securitize, are good at building out those pieces to really connect the dots there.
So as we looked at Chainlink before, you can see certain use cases coming through like interoperability. one of the big ones that I think about is data on fixed income markets and like benchmarks. So just something very simple in traditional finance would be variable rate lending. So you have a benchmark like SOFR, secured overnight funding rate, and then most private credit or corporate lending might be priced at SOFR plus 300, 500 basis points or 3 to 5%. Something like that doesn't really exist on chain at the moment, but it's such a simple thing, but so important. And providers like Chainlink are really important. If I have something that I can incorporate into Maple, where it's always getting a feed of what is SOFR, and then we're able to price our interest rates off of that, it saves us a lot of time. Really important for scalability, and also really important for the types of customers that we attract, just because that's going to then appeal to a more established set of kind of TradFi type investors. So that's one thing. The other one is, of course, interoperability. There is now a really non-trivial number of L1s and L2s that you have to think about building on, and so having the ability to either shift assets between them seamlessly, or have a liquidation that occurs on one chain impact something on another chain, or a loan on another chain, is super important. And again, very, very important for scaling as we start to see the ecosystem kind of specialize, where certain activity takes place on one chain. Maybe RWA activity is taking place increasingly on a chain like Avalanche, and NFTs are taking place on Solana. So I think first off, data and getting real world indicators and information, and then secondly, interoperability are probably the main ways that we look at using Chainlink today.
Yeah, so I'd echo similar comments. I think for me, it's kind of two elements. One is a lot of traditional markets and finance function on proprietary information and like purposeful information asymmetry. So you have a platform like Chainlink that's kind of omnipresent across the space, and we work with being a bridge between kind of those legacy institutions, and they don't have like Sid, when you built Maple, like from the outset you were crypto native, right? So there's not like a team at these places that is super excited about like, oh, here's transparency and like here's the data feed, like go have at, right? So I think that's one element. And so being able to work with those institutions, us being kind of that input into Chainlink. And then the second is, it's trusted and it's across all of the networks. And so, that's a great service for being able to kind of help create reliable feeds for how some of this pricing works. For example, these funds, like, maybe you'll get, for a money market fund, you'll get a daily NAV of 1, but that fund admin sits somewhere and does calculations in a spreadsheet and then sends it to the transfer agent, and like that's probably through an email, and that's not in real time at all. And then you kind of move out one step from like a money market fund to any real private fund, and you're lucky if you're getting a NAV once a month, right? Which we may talk about this later, but like that's also one of the things that's interesting too, is kind of the focus on liquidity as a spot dynamic in crypto versus like the quality of an asset that doesn't have the same volatility of, call it 50% over a month. But I'll save my thoughts for that on later.
Fair enough. All right, so I think we can get to this. I think as we wrap here, what'd be really interesting is your thoughts on like what's the most exciting trends that you're seeing, and perhaps we know what yours might be, Reid. But like most exciting trends, we can talk about that, and then like what we should be on the lookout for from you guys specifically in the near future.
So I'd say most exciting trend I've seen is increasing amount and use of stablecoins. I think it's easy to not get too excited about it when there's more complicated stuff happening, but we're kind of like fish swimming in the ocean, and that's sort of the water that we need. If you look at almost all of Maple's lending activity is in USDC, so stablecoins. And so as we look at the overall market size, that's really the constraining factor. So once you start to get to like $1 trillion of stable coins out there, you're going to see a ton more commercial activity happening on chain that just can't happen today at the smaller volumes. So that's kind of a simple one, but a really exciting one, an important one for us. The other one I look at a lot is just, as we have Maredith here, but institutional adoption of blockchain technology, I think, is something that's taken a long time to play out. But that is where the largest volume of assets resides today. And so that's something that we pay a lot of attention to. And in the short term, what I'm paying attention to most is the regrowth and kind of the reestablishment of the lending market. So this was totally dead in 2023, but we're seeing it come back again. There's a lot more demand for credit, and ultimately you need that if you want to have a healthy, functioning on-chain ecosystem. For anyone who goes and trades on Coinbase, you're largely going to be trading with a player like Wintermute or GSR, and guess what? Those guys have to go and borrow their inventory from people like Maple and other lending platforms out there. So I think that's really important for the space to kind of grow and heal again.
And I would just add to the stablecoin piece. I think it's the overall arching theme of on and off ramps, and that means bringing on-chain assets, whether it's through something like USDC or other stable coins, is really important to build out this ecosystem, but also the off-ramp element for people to be able, especially on the retail side, to be able to still interact how they're used to interacting with their financial lives. I think to date, crypto has been very, very separate from the traditional finance, fixed income, equities type of markets, where now we're seeing that convergence, where now tokens are on the same value chain. And that means a lot of different things, where a private credit token can sit next to your USDC stablecoin, which can sit next to a share of a painting that you own. And that is really cool as you start to think about your whole financial life. And so I think there's a macro piece here too that I'm really excited about to see. That's probably many years away. But in the meantime, it's getting the masses more comfortable with the adoption. And that's really focused on the usability framework here that we're focused on building out.
Yeah, so I mean, I very much believe that not everything needs to be tokenized, but everything ought to be able to be tokenized. And I think it kind of flips the dynamic on its head, which is not necessarily the quality of the asset, but how big your borrow is going to be is what ultimately drives a traditional lender to be able to lend to you. So for us, it's being able to build out both kind of legal and financial engineering structures that allow assets that you have today to exist on chain in a dynamic that is legal and compliant, but can still take advantage of the massive liquidity and interest for lending opportunities on chain. And so being able to kind of think about assets for their longer term quality and not necessarily and this is not like a dig on crypto at all, but the way most CDP platforms work today is a function of what is the price today, and I don't really care what the underlying is because we'll just liquidate it. But think about longer term assets that don't have kind of this crazy volatility, which allows you to actually then bring more things and keep more things on chain without needing to go find a bank.
Love it. So how about how do we follow what you're up to and any announcements? And how do people keep track of the good stuff that you guys are doing?
Sure. So securitized.io is our website. We have a Twitter as well. And other than that, there's usually press releases, but we don't move in a very day by day kind of basis because we're a bigger ship, or I should say our partners and clients are bigger ships. So it's not kind of a day-to-day interaction. But yeah, we have some exciting updates on our products that are out today. And we also do have some qualified investor and soon to be retail offerings on the platform as well.
Awesome. For us, it's maple.finance. On Twitter, we're at maplefinance. I'm at syrupsid. Generally, we do a webinar once a month if anyone cares to tune in, and we'll talk generally about interest rates on chain, what's happening, a bit of market color, not always kind of shilling what we're doing.
And obviously wisdomtree.com, and you can follow I think we have probably 5 Twitter handles and LinkedIn pages across all of our entities. So just search for WisdomTree, and you can follow me. I do a lot on LinkedIn and then a little bit on Twitter. You're probably way cooler than me on Twitter, but yeah, we do a lot, especially from a publicly traded company perspective, a lot of press releases, but also try to do a lot in terms of just what's going on in the industry. And obviously there's so much going on just amongst our 3 institutions and so much in the ecosystem that's really exciting. So yeah, follow along.
Well, let's give a round of applause to our panelists. Thanks so much, guys.